Every time you log into your banking app or swipe your debit card at the grocery store, you operate under a profound, invisible assumption that your money is actually there. But the ironclad guarantee that makes your digital balance real, the federal promise that a bank failure will not instantly vaporize your life savings, did not exist in America until 1933. Before that moment, depositing money in a bank was essentially a high-stakes gamble. What happened when banks just kept your money, operating without a universal safety net, leaving ordinary citizens completely exposed to the catastrophic miscalculations of the financial elite? This is a story about the raw architecture of financial power, the devastating psychological terror of the bank run, and the brutal, century-long struggle to force the government to protect the public from the reckless speculation of Wall Street. To understand the sheer terror of early American banking, you have to strip away everything you know about modern finance. In the 19th century, opening a savings account was an act of extreme faith. The United States operated in a state of financial frontier justice, characterized by what historians call the free banking era. Between the closure of the Second Bank of the United States in 1836 and the National Banking Act of 1863, virtually anyone could open a bank. You did not need federal approval. You barely needed capital. You simply needed a printing press and a state charter, which was often obtained through political patronage rather than financial stability. When you walked into a local bank and handed over your physical gold or silver coin, the bank handed you back its own custom-printed paper currency. These individual banknotes were merely IOUs, promises to pay back your gold upon demand. The bank then took your hard currency and loaned it out to farmers, railroad speculators, and land developers. This is the fundamental mechanic of fractional reserve banking, a system where the institution only keeps a tiny fraction of total deposits in the vault. Today, this system is stabilized by federal insurance. Back then, it was stabilized by nothing but blind trust and local gossip. If a rumor began to circulate that the local railroad company was failing and the town bank had heavily financed that railroad, panic would ignite instantly. A single whisper of insolvency was enough to trigger a bank run. Citizens would sprint to the bank doors, desperate to exchange their paper notes back into gold before the vault ran dry. Because the bank had loaned out the vast majority of the deposits, only the first few people in line would get their money. Once the gold was gone, the bank barred its doors. The remaining paper notes in the hands of the terrified crowd instantly became worthless scraps of paper. Families who had saved for decades were rendered destitute in a single afternoon. There was no recourse, no federal hotline, no emergency bailout. Your wealth simply evaporated. This was not a rare anomaly. It was the defining rhythm of the American economy. Cataclysmic financial panics swept the nation with terrifying regularity. The Panic of 1837, the Panic of 1857, the Panic of 1873, and the Panic of 1893 were not just market corrections. They were systemic implosions that wiped out millions of ordinary depositors. During these crises, the power dynamic between the financial class and the working class was laid bare. Wealthy financiers and bank directors, who often had inside knowledge of failing investments, could quietly withdraw their specie before the public caught wind of the danger. The losses were entirely socialized, borne by the farmers, merchants, and laborers who had trusted the institution with their livelihoods. The injustice of this system did not go unnoticed. Long before the federal government intervened, desperate states attempted to build their own localized safety nets. As early as 1829, New York established a safety fund, requiring state-chartered banks to contribute a fraction of their capital into a collective pool designed to pay out depositors if a member bank failed. It was a revolutionary concept, the earliest precursor to modern deposit insurance. But it was fundamentally flawed. The fund was too small, the assessments on the banks were too low, and it was entirely unprepared for a systemic crisis. When the Panic of 1837 hit, dragging down banks across the entire state, the New York Safety Fund was rapidly overwhelmed and went bankrupt. Similar experiments were attempted in Vermont, Michigan, and later in the Midwest during the early 20th century. Between 1907 and 1917, 8 states established their own deposit guarantee systems, driven by populist outrage against Eastern financial elites. These state-level systems worked beautifully during times of economic expansion, but they all shared a fatal architectural weakness. They lacked the vast, diverse economic base and the infinite liquidity of the federal government. When agricultural prices collapsed after World War I, rural banks failed in droves. One by one, every single state deposit insurance fund collapsed under the weight of localized economic depression, leaving depositors exactly where they started, holding worthless promises and empty bank books. The recurring failure of these state experiments reinforced a dangerous ideology among the highest levels of American government and finance. The prevailing wisdom of the era was that insuring deposits was inherently dangerous. Leading economists and powerful bankers argued that guaranteeing deposits would create moral hazard. If banks knew the government would bail out their depositors, the argument went, bankers would take increasingly reckless risks with the public's money, knowing they would face no consequences for failure. Wall Street adamantly opposed any form of federal guarantee, viewing it as an unnatural interference in the free market. They believed that the fear of a bank run was a necessary disciplinary mechanism, the only thing keeping reckless bankers in check. But this philosophy of financial Darwinism ignored a brutal reality. The disciplinary mechanism of the bank run did not punish the reckless bankers, who often walked away with their personal fortunes intact. It punished the innocent depositor. The working public was effectively held hostage by a financial architecture that demanded their capital to fuel national expansion, but refused to offer them a shred of security in return. As the Roaring Twenties approached, bringing an unprecedented era of stock market speculation and unregulated banking expansion, this fundamental imbalance of power was setting the stage for the greatest economic catastrophe in human history. The system was primed for a reckoning, and it would take the complete collapse of the American banking apparatus to finally shatter the resistance of the financial elite. The decade leading up to the Great Crash was characterized by a dangerous illusion of permanence. Throughout the 1920s, the American economy surged, fueled by mass production, consumer credit, and an unprecedented speculative frenzy on Wall Street. Beneath this veneer of roaring prosperity, the banking system was undergoing a quiet, structural mutation. Traditional commercial banks, which were supposed to be conservative custodians of the public's deposits, began to look enviously at the massive profits being generated by investment brokers. Seeking a piece of the action, major financial institutions established so-called securities affiliates. These were essentially shadow companies, legally attached to the bank, but operating outside the already loose regulatory boundaries of the era. Through these affiliates, banks began funneling the life savings of ordinary Americans directly into the stock market. Leading the charge was Charles Mitchell, the aggressively ambitious president of National City Bank, which would eventually become Citibank. Mitchell pioneered the mass marketing of high-risk securities to everyday depositors. When a citizen walked into a branch to deposit their weekly wages, tellers were incentivized to push them toward buying stocks and foreign bonds, often using the bank's own money lent to the depositor on margin. The firewall between conservative saving and speculative gambling was systematically dismantled. Wall Street executives argued this was the democratization of finance, a new era where everyone could share in the wealth. In reality, it was the construction of a financial house of cards, built on a foundation of uninsured, unprotected public money. When the stock market collapsed in October of 1929, the sheer velocity of the destruction caught the public completely off guard. But the initial crash, devastating as it was for investors, was only the detonator. The true catastrophe was the institutional contagion that followed. As stock prices plummeted, the margin loans that banks had aggressively issued became toxic. The securities affiliates, heavily invested in their own artificially inflated stock, faced massive shortfalls. To cover their losses, these institutions began quietly draining the reserves of their commercial banking arms. The money that farmers, teachers, and mechanics had deposited for safekeeping was suddenly tied up in worthless paper. The psychological terror of the bank run, a localized fear during the 19th century, now became a national contagion. The defining moment of this systemic psychological collapse occurred in December of 1930, with the failure of the Bank of United States in New York City. Despite its official-sounding name, it was a private commercial bank, holding the savings of hundreds of thousands of working-class immigrants in the garment district. When rumors of its insolvency leaked, crowds swarmed the branches. The financial establishment, led by the major Wall Street clearing banks, held an emergency meeting to decide whether to save the institution and halt the panic. They chose to let it die. When the Bank of United States locked its doors, taking $200 million of deposits down with it, a shockwave of absolute panic ripped through the American consciousness. It was the largest bank failure in the nation's history up to that point. The unspoken message to the American public was clear. No institution was safe, no amount of savings was protected, and the financial elite would not rescue you. Driven by raw survival instinct, Americans began a mass withdrawal of wealth from the banking system. People hoarded gold coins under floorboards, stuffed paper currency into mattresses, and buried coffee cans full of cash in their backyards. This rational act of self-preservation by millions of individuals had an absolutely devastating macroeconomic consequence. As cash vanished from bank vaults, the banks had to call in loans from local businesses to maintain their required reserves. Businesses, suddenly stripped of credit, were forced to fire their workers or shut down entirely. The unemployed workers then defaulted on their mortgages, pushing the banks further toward insolvency, triggering even more bank runs. It was a perfectly designed death spiral. By 1932, the American banking system was in a state of terminal cardiac arrest. Thousands of banks had vanished. Entire towns were left without a single operating financial institution, forcing citizens to resort to barter systems using wooden scrip or IOUs just to buy groceries. The federal government, under President Herbert Hoover, remained paralyzed by the orthodox economic belief that government intervention would only prolong the pain. Hoover eventually authorized the creation of the Reconstruction Finance Corporation, a federal agency designed to offer emergency loans to failing banks. But the agency operated in strict secrecy, and its loans were heavily collateralized, meaning it only helped banks that already had good assets. It did absolutely nothing to guarantee the deposits of the everyday citizen, and therefore did nothing to stop the panic. The political and financial power brokers of the era continued to fiercely resist any proposal for federal deposit insurance, clinging to the old arguments of moral hazard. They watched the economy burn, insisting that the free market was simply purging the weak institutions from the system. But the people losing their homes and their life savings were not weak institutions. They were the foundation of the American Republic. The tension between a population completely stripped of its wealth and a government refusing to provide a safety net was pushing the nation toward the brink of social revolution. The architecture of American finance had entirely collapsed, and whoever took power next would be forced to rebuild it from the ashes, or risk losing the country entirely. The winter of 1932 to 1933 was the absolute nadir of the American financial experiment. By February, the localized panics had coalesced into a massive, unstoppable national hemorrhage. State governors, desperate to stop the bleeding, began unilaterally declaring statewide bank holidays, forcibly locking vault doors using state militias. When Franklin Delano Roosevelt took the oath of office on March 4, 1933, the banking system of the United States had effectively ceased to function. The New York Stock Exchange suspended trading. The Chicago Board of Trade shut down. For the first time in the nation's history, the financial heart of the country simply stopped beating. Roosevelt's immediate response was an exercise in unprecedented executive power. On March 6th, he invoked a World War I-era statute to declare a 4-day national banking holiday. Every single bank in the country was ordered to close its doors and halt all transactions. It was a drastic, terrifying maneuver, but it fundamentally broke the psychological momentum of the panic. During those 4 days, while the American public survived on credit and IOUs, Congress hurriedly passed the Emergency Banking Act, granting the Treasury Department the authority to inspect every bank and only allow the solvent ones to reopen. But a temporary holiday and federal inspections were not enough to restore public trust. The people demanded a permanent guarantee. The political pressure from the terrified working class collided with the entrenched resistance of the financial establishment. Surprisingly, Roosevelt himself initially sided with the establishment. The president was deeply skeptical of insuring deposits, echoing the old Wall Street argument that the government would end up subsidizing the losses of bad bankers. The true architect of the modern safety net was not the president, but a populist congressman from Alabama named Henry Stigall. As chairman of the House Banking and Currency Committee, Stigall channeled the raw, unyielding fury of rural America. His constituents had seen their agricultural banks obliterated in the 20s, and they demanded federal protection. Stigall refused to pass any broader banking reform unless it included a mandatory, federally backed insurance mechanism for ordinary depositors. He allied with Senator Carter Glass of Virginia, who was determined to forcefully sever the toxic relationship between commercial banking and Wall Street speculation. The resulting legislation was a monumental forced compromise. The Banking Act of 1933, widely known as the Glass-Steagall Act, fundamentally redrew the architecture of American finance. It mandated that banks choose between taking deposits or trading securities. They could no longer do both. But its most enduring legacy, forced through by Stigall's relentless pressure, was the creation of the Federal Deposit Insurance Corporation. The standardized federal deposit insurance we know today wasn't introduced until this exact moment in 1933. The FDIC was a brilliantly simple mechanism designed to neutralize the psychological trigger of the bank run. It required participating banks to pay a small premium into a massive, federally managed insurance pool. In exchange, the United States government placed its full faith and credit behind the deposits of everyday citizens, initially insuring accounts up to $2,500. If a bank failed, the federal government guaranteed that the depositor would be made whole, immediately and fully, up to that limit. The legislation was signed into law on June 16, 1933. Wall Street executives were apoplectic, warning that the FDIC would destroy the banking industry by forcing conservative Eastern banks to pay for the mistakes of reckless Western bankers. The American Bankers Association fought the measure bitterly, lobbying for a presidential veto. But the theoretical arguments against moral hazard were instantly obliterated by the sheer, undeniable reality of the public's reaction. When the newly insured banks reopened, the terrified hoarding that had strangled the economy abruptly reversed. Citizens who had spent 3 years desperately pulling their money out of the system suddenly turned around and lined up to put it back in. Within weeks, over $1 billion in hoarded cash and gold flooded back into the bank vaults. The bank run, the terrifying specter that had haunted the American working class for a century, was effectively eradicated overnight. The power dynamic had shifted. The public no longer had to rely on the blind trust of local bankers. They were now backed by the sovereign architecture of the state. The true test of this new financial architecture arrived on January 1st, 1934, the day the Federal Deposit Insurance Corporation officially went into effect. Across the country, thousands of local banks proudly displayed a small, unassuming black and gold plaque in their windows and at teller cages, bearing a simple promise: deposits insured. That simple piece of signage became the most powerful psychological talisman in American economic history. It was visual proof that the rules of the game had fundamentally changed. You were no longer just trusting the men in the back office of your local branch. You were holding a contract underwritten by the United States Treasury. The immediate consequences were staggering. In the decade prior to the creation of the FDIC, thousands of banks failed every year, wiping out billions in unrecoverable wealth. In 1934, exactly 9 insured banks failed in the entire country, and in every single one of those 9 cases, the depositors were made entirely whole within days. The working class had won a monumental victory. For the first time, the financial safety of a farmer in Nebraska or a garment worker in New York was not tethered to the speculative success of a Wall Street syndicate. The devastating era of the localized bank run was structurally eradicated. But the financial elite, who had bitterly fought the creation of the FDIC, also experienced an unintended consequence: the stabilization of their own industry. By removing the threat of mass public panic, the federal government had essentially saved capitalism from its own most destructive tendencies. However, the price of this federal guarantee was profound. Because the government was now on the hook for billions of dollars of insured deposits, it claimed the absolute right to strictly audit, regulate, and discipline the banking sector. The frontier era of wildcat banking was permanently closed, replaced by a massive bureaucratic apparatus of federal examiners and strict capital requirements. Yet the core tension that defined the creation of the FDIC, the fierce debate over moral hazard, never actually vanished. It merely mutated. The conservative bankers of the 1920s warned that if you insulate institutions from the consequences of failure, you encourage reckless risk. For decades, the strict divisions of the Glass-Steagall Act kept that risk in check. But as those regulations were slowly dismantled by intense financial lobbying at the end of the 20th century, culminating in the repeal of Glass-Steagall in 1999, the old ghost returned. Today, the FDIC insures accounts up to $250,000, a vast expansion from the original $2,500 limit. But as modern banking has grown infinitely more complex, and as massive institutions have once again collapsed under the weight of their own speculative investments, we are forced to confront the very same dilemma that paralyzed Washington in 1933. When the government guarantees the public's money, does it inevitably encourage the very financial recklessness it was designed to prevent? Or is that a necessary price to pay for social stability? The invisible shield that protects your digital balance today was not a natural evolution of the free market. It was a desperate emergency mechanism forged in the crucible of a national collapse, designed to protect the vulnerable from the systemic failures of the powerful. The next time you tap your card or check your savings, remember that your security was bought and paid for by a generation that lost everything. If you want to understand the hidden architecture of the systems that govern your daily life and uncover the historical battles that built our modern world, subscribe to our channel.